This is wild, guys. So I had a list agent who's one of my friends call me this week, and he's having trouble selling a house. Now, they've dropped the price several times on this house. And by the way, this is a nice neighborhood. I'm not going to say which one it is, but it's maybe West Haven or Berry Farms or Governor's Club. It's like a $1 to $3 million neighborhood. But anyways, $1 to $3 million neighborhood. And it is a little bit older in the neighborhood, so there's a ding there. But he told me, he said, Ethan, my sellers would take another $200,000 off of the list price if someone offered right now. These are not distressed sellers. They have a ton of equity. They're just finished. They're finished. They have equity and they're ready to move and be near their grandkids. And they are willing to give up more than 10% of a list price that's already priced really well from a sales comp perspective. Okay, now I immediately went into investment mode and I thought, okay, does this make sense? The answer, no, not for an investment. But for someone trying to house hack into the neighborhood, this is a no-brainer. Now, how could it be that it's a bad investment, but a great home purchase? Now, I'm going to explain this. And kind of funny enough, I did send this listing to some of my buyers. The responses were wild. I did get some interest, but others were like, yes, this is the crash we've been waiting for. And I thought, this is kind of interesting. You see, this property, the comp is 25% below what the lower quartile in the neighborhood is. This is a nice neighborhood, 25% lower than the lower quartile. Now, if you don't know what lower quartile is, if you take the median and you cut off everything above the median, and then you take the median again, that's the lower quartile. From a sales comp perspective, this is a home run. The problem is in a crash, it would be horrible to look at sales comps. The trend would show a line straight down. And I can show you some other ways to value this home to decide whether or not it's still a good home value. Because let's be honest, if this truly is the beginning of a crash, how do you know if you're catching a falling knife or this is actually a fantastic purchase? I'm going to show you multiple ways to value a house so you can decide whether you think you're catching a falling knife or making a sound home purchase decision. In my opinion, these are better than just looking at sales comps. Ironically, this is all happening just as home prices hit another record high. And believe it or not, even as they're hitting a record high, Redfin, Zillow, Altos, they're all starting to get much more bearish on the housing market. What are they looking at? And could we see the home price crash that we've been waiting for? It's funny. If the market was crashing, would you choose to buy? The answer is probably not. You would say, Ethan, why would I buy when it's getting cheaper every single day? And so maybe we're asking the wrong question. Maybe you're looking for a crash because you're actually looking for prices to make sense. So what is Zillow, Redfin, and Altos looking at? They're looking at price cuts, and they're looking at sellers selling into lackluster buyer demand. You see, as buyers are struggling to buy at the same pace they did last year, sellers are increasingly listing their homes. It's actually pretty wild. Now, I've covered this, but in greater Nashville, we just hit another high in inventory. It's up 17% year over year. That's even as last year's inventory was climbing. So it's climbing at a faster pace than it was last year. And when we look at price cuts, this year they started much lower, and now we are on track to hit 35% cuts, maybe by next week. 35% is the number that Altos calls as shifting into a buyer's market and looking to see home values falling. Now, the fact that it's happening in the month of June, where normally this would happen much later, like August or September, that's kind of a yellow flag. And what gets even crazier, and I've covered this in other videos, but price cuts lead to additional price concessions, just like my friend's listing. They've already cut the price big time on this house, and they're willing to cut it even more. And when we aggregate this, it's obvious where concessions are heading. Now, let's look at the inverse correlation with concessions and price. Concessions are a strong indicator that prices will fall. So it's obvious to me that prices are starting to peak and fall. And while a good chunk of this is seasonal, this year will likely dip more than last, just because of where price cuts as a percentage of listings are and the momentum it has going into late summer. Now, again, this begs the question, why not wait? Is there a compelling case to buy? Now, for some of you, you have to buy. You're trying to get into a school zone, you're trying to land for your family, and you're just trying to make the best decision you can. But let's go back to the beginning on what made this house so attractive as a home purchase, but not as an investment. You see, everyone looks at sales comps as the golden rule for property values. The problem is the greater fool theory. Sometimes things can unhinge from their price, but as long as there's a greater fool to buy it, that can perpetuate. It can only go on for so long before something corrects. So is there another way to value a house? The answer is yes. There's two great ways to value a house, and one that you could do right now pretty quickly. You see, besides the sales comp approach that most everybody uses, there's the income approach and the cost to build. Now, cost to build is actually pretty complicated, and for an average person, it's going to be very difficult to do. You would need to know costs, and you would have to basically have insider information. Now, you can kind of triangulate it using what new builds around you are doing, estimating margin, looking at the incentives they're offering. But the truth is it's extremely difficult, and it's going to be not very precise. However, the income approach is very attainable and without question will help you rationalize a home purchase decision. It will show you relative value because it's showing you what the market is willing to pay monthly for your house. If rates truly are staying higher and staying elevated for longer, it just doesn't make sense to buy when the rent is so far away from what a monthly payment or a borrowing cost would be. Well, here's a very basic way to do income approach. And I get that there's, a lot more complicated variables in this, but this super simple approach will save you so much heartache and get you so much closer at just another way to look. Okay, so take a listing and calculate what your mortgage payment would be. Now make sure you're including taxes, insurance, and HOA. These are mostly public knowledge, and they vary by state and area, but you can generally estimate those pretty well, or ask somebody, you can get good estimates for them. Now, once you do that, compare it to what it would rent for. Now, I typically use Zillow, and if you have an agent, you can ask for comps on the MLS that are recorded. But what you can do is you can find a listing on Zillow, make sure you're using the same number of beds and pretty close to the same square footage, and look for a listing that actually has activity on it, contacts and applications. If it's been sitting for 30 or 60 days with zero contacts, it's probably not a good listing. But you can find what a comparable listing would rent for, and you can use that and compare it to your mortgage payment. Now, if you're going to live there, then you don't have to pay a management fee or lose money on vacancy. These are two very big costs to investors, and they can cost up to 15 to 20% of the income on a house. In that respect, an owner-occupant has a huge advantage over investors from a return perspective. Now, going back to the listing that my friend had mentioned to me, it came with an apartment that has over $2,000 a month currently being rented for it, and market would probably be about $2,500 a month. The main area would rent for $6,000 to $8,000 a month. And so when you compare that to a mortgage with 20% down, even including the HOA, you're going to be right at $8,000 a month for this house. So $8,000 a month for a mortgage, taxes, insurance, and HOA, okay? Or you can get potentially over $10,000 a month in rent. That is by far the best deal in this neighborhood that I've seen in years. And given that rents are pretty sticky, they didn't go up nearly as much as mortgage payments did over the past 2 years. It's not going to be as volatile. So if you can check the box on the sales comp approach, remember this one's 25% lower than the lower quartile. And then you can check the box on the income approach. In this case, the rents would well exceed what the borrowing monthly payments would be. Even if you can't find the cost to build, at least check what new builds are going for in the area and the incentives that they are offering, and make sure that builders aren't crushing the home values around you. If you can do all three of those things, you're not boxing yourself in. And if you can afford the house and rents are higher than your payment, you have much less to worry about, even if home values do go down. You will still be in a position of strength and will keep yourself from being a forced seller if you do decide to move. Forced sellers will definitely lose money. That's the one thing you want to protect yourself from. So you will be in a much better position than average. And in the long run, your house will be worth more, at least in US dollars. I can't say for Bitcoin or gold or anything else, but we do have a federal government that is absolutely committed to seeing the dollar devalue over time. And that inherently will make your house worth more over time. So it is a place to store value. And if it's something you're already living in, to find a home that checks all the boxes can be a huge win and certainly protect yourself from a downside. But if you can't handle the prospect of prices dropping double digits significantly, maybe even 30%, I just wouldn't buy in this market. However, if you're comfortable with that, in the long run, prices will go up, and there's no guarantee that they will go down. There's no guarantee that there will be a crash. I know people think that. I know they look at the charts. I have debates with many great friends on this subject, and very smart people disagree about the outcome of what's going to happen with the housing market. If this was helpful, please click the like button. It certainly helps the algorithm. And with that, I look forward to seeing you next Saturday. Thanks for watching.